the power of small but sustainable gains. In investing, attention gravitates toward dramatic returns, doubling capital, catching explosive trends, or timing major market moves. Yet long-term wealth is more often built through small, repeatable gains sustained over time. Sustainability, not intensity, is the foundation of compounding. 1. Compounding rewards consistency. Albert Einstein is often, perhaps apocryphally, credited with calling compound interest the eighth wonder of the world. Whether or not he said it, the principle remains true. Small returns, consistently applied, create exponential growth. Investor and author Morgan Housel emphasizes that wealth is less about dramatic wins and more about avoiding catastrophic losses, while letting compounding work uninterrupted. For example, a steady 8% annually for 25 years multiplies capital over 6 times. A volatile path of plus 40%, minus 35%, plus 25%, minus 30% often ends with stress and stagnation. Consistency beats bursts. 2. Risk management enables longevity. Nobel laureate Harry Markowitz showed that diversification reduces risk without necessarily reducing expected return. Sustainable gains rely on managing volatility, not maximizing upside. Small gains preserve capital, reduce emotional pressure, increase survival probability, allow long-term participation. In markets, survival is a competitive advantage. 3. The mathematics of loss. Losses hurt more than equivalent gains help, a concept explored by Daniel Kahneman and Amos Tversky in Prospect Theory. Mathematically, a 50% loss requires a 100% gain to recover. A 20% loss requires a 25% gain. Strategies chasing large returns often accept large drawdowns. Sustainable strategies prioritize avoiding deep losses. Protecting downside improves long-term compounding. 4. Behavioral sustainability. High volatility strategies are difficult to stick with. Investors abandon them during downturns. Warren Buffett emphasizes temperament over intelligence. A modest strategy you can follow consistently often outperforms a brilliant strategy you abandon under stress. Small gains are easier to tolerate, easier to automate, easier to repeat. Consistency reduces behavioral mistakes. 5. The incremental advantage. In performance psychology, marginal improvements compound. The British cycling team popularized this approach under coach Dave Brailsford, focusing on 1% improvements across many variables. Investing works similarly. Reduce fees slightly. Improve savings rates slightly. Avoid unnecessary trades. Rebalance systematically. Small optimizations accumulate into significant long-term advantage. Why small sustainable gains win? They lower emotional volatility, reduce catastrophic risk, improve adherence, enable uninterrupted compounding, increase probability of long-term success. Investing is not a sprint, it is an endurance discipline. Conclusion: large gains excite. Small sustainable gains build wealth. A strategy that earns moderate returns consistently over decades often outperforms strategies chasing spectacular but unstable outcomes. In the long run, stability compounds, survival compounds, consistency compounds, and small, repeatable gains become powerful precisely because they endure.